At the beginning of 2021, Beyond Meat's stock price was here. But now, a big bite has been taken out of that. It's fallen by more than 90% in just under 2 years. Despite a promising debut on Wall Street, celebrity endorsements, and a growing presence in restaurants and supermarkets, during the last year, Beyond's sales have slumped. Just in the 12 weeks ending October 8th, grocery sales declined by 21%, even though the wider category only fell by 8%.
That indicates that there's something foundational happening at the company, that it's more than just the consumer trend.
So, what went wrong?
But are you saying don't eat meat?
No, what I'm saying is let's not eat animal protein.
Okay, great.
Beyond was founded in 2009 by CEO Ethan Brown. The goal? To create a healthier, more humane, more earth-conscious alternative to meat.
If we were to reduce meat consumption globally by 25%, we could address a huge amount of the climate change problem.
They're looking to appeal to meat eaters with a product that they are intending to look and cook and taste just like meat.
Beyond pushed to have their products in meat cases, right next to the actual thing, starting in 2016 with a burger in select Whole Foods and gradually moving into more supermarkets. The company also worked early on to get their products into the public eye, partnering with restaurants like Del Taco, Dunkin', KFC, and TGI Fridays.
There was a lot of hype, a lot of buzz around this product. It was sort of the cool thing that people wanted to try out and have on their backyard grills for a minute.
The company attracted big-name partners like Leonardo DiCaprio and Snoop Dogg before going public in 2019. Beyond's success was driven by Brown, who pushed for rapid and relentless innovation, an idea borrowed from the tech sector.
Everything we do is around how do we get people to think and act more urgently. What I'm interested in is becoming that larger company. I have a goal to make this a $40 billion company in terms of revenue.
Beyond's business model focused a lot on growth. They wanted to introduce a lot of products to market. They wanted to, capture market share and have their products be the one that got in front of consumers.
By the end of 2020, the company's sales grew to almost $407 million. But that push for growth came with mounting expenses. At the same time net revenue was growing, the company reported $1.1 billion in debt, and it still wasn't profitable.
Their cost structure then just outpaced sales. So essentially, they wound up over-investing for business that hasn't yet developed.
Problems with the pace of production were starting to show. Some current and former employees at Beyond told the Wall Street Journal that the rush to get products to market came with a disconnect between the teams that created products and the ones that had to produce them.
Ethan Brown and other executives would show these products that had been made by hand in small quantities in their labs. They would show them to customers, to restaurants, and to retailers, and generate, a lot of excitement about these new innovations based on these prototypes. But then their commercialization team would receive the new innovations and actually, really struggle to commercialize or to scale up these products.
One example of problems is a version of dinner sausages that hit shelves in 2020 and sagged when stored vertically. Insiders at the company said the product didn't go through sufficient testing. According to those current and former employees, some customers were turned off by the appearance and didn't like the new flavor or feel, and the company eventually had to pull them from stores, according to internal emails. Beyond also struggled with manufacturing for new products like chicken tenders and jerky. Former and current employees also said the rush to market led to a lot of waste. Equipment was purchased that wasn't needed. Packaging for new products would be printed before nutritional facts were confirmed and had to be discarded. And a European expansion struggled because of the food's limited shelf life. Some at the company attributed these problems to Brown's leadership.
A lot of employees that we spoke to said that he has really struggled to manage Beyond's growth, and that in particular, he really struggled with planning and prioritizing and sticking to the company's priorities, and that led to a lot of confusion and frustration among employees.
Some former and current employees said that Brown is an open-minded leader who sets clear plans for the company, and Beyond's board chair said he supports Brown. A spokesperson from Beyond previously said in a statement to the Wall Street Journal that the company operates from a 3-year strategic vision and an annual plan. By the end of 2021 and beginning of 2022, Beyond's stock price fell as grocery sales slipped. The company had scaled up its supermarket presence after the COVID-19 pandemic hurt its food service business.
And so the fact that sales are down at grocery, just is a significant problem for the business.
Their push to get more products in grocery stores also resulted in some expensive production. The company said a jerky product, made in partnership with PepsiCo and launched in March, initially had a complex and high-cost manufacturing process. In November, Beyond said that the jerky had reduced the company's gross profit by nearly $6 million in the third quarter. By September 2022, Beyond's stock price hit a low.
They are losing more and more money each quarter. They're amassing debt. They're sort of having a run of bad luck.
Beyond was also losing market share to competitors. In the same period in October that Beyond's grocery sales declined, rival Impossible Foods sales rose. Beyond is still figuring out how to scale down as it moves forward.
The focus on being first to market is obviously really important, but rushing the process has its consequences.
In November, Brown said that the company would focus on their core products. He previously announced that they would be shifting to a more sustainable growth model, which included cutting 19% of their staff.
The path forward in this environment is clear, and at its foundation is a pivot from the growth above all operating model that has characterized our business to date to one that prioritizes positive cash flow and sustainable growth.
In a previous statement to the Wall Street Journal, a spokesperson said, "The pace and intensity of our innovation is not for everyone. It does, however, produce extraordinary results." The shift away from growth is a major change in mindset for the company, but some think that scaling down will help it stay afloat.